Welcome to the deep dive. Okay, let's talk about the market. If you're like me, these last few weeks,
hmm
uh, they've probably been a bit nerve-wracking.
Definitely seeing some volatility. Those red days can get anyone feeling uneasy.
Right. And then you see these headlines popping up everywhere about this death cross on the S&P 500. Sounds pretty dramatic.
It does have an intimidating name, doesn't it?
Yeah.
It's a technical pattern people watch.
Explain that a bit. What exactly is it?
Sure. So you have these moving averages, right?
Yeah.
They smooth out prices over time. The death cross happens when the shorter term average, usually the 50-day, falls below the longer term one, the 200-day average.
Okay.
The theory is it signals that the recent downward momentum is maybe becoming a longer-term trend.
Yeah.
And yeah, you're right. This is the first weekly death cross we've seen on the S&P since back in 2022.
So it gets attention. And it feels like other news just piles on, like the NVIDIA story, big company, lots of eyes on it.
The charge they announced.
Yeah. A multi-billion-dollar charge linked to those China chip sales. It just adds to that general feeling of, well, worry.
It all feeds the narrative, absolutely.
Exactly. So that's why in this deep dive, we want to look past just the scary headlines. Our mission here is really to dig into the underlying data and also what's happened historically when we've seen this pattern. We want to get a better handle on what the actual investor appetite is right now and honestly what this death cross signal might really mean for you.
That's the crucial part. And we're going to approach this from two angles. First, we'll look at some key current market data points, what's happening, like right now.
Okay.
And second, we'll zoom out and examine the historical track record. How has the market actually behaved after these death crosses in the past?
All right, let's start with that current data because this is where things get,
Yeah.
well, pretty interesting, I think.
Go on.
Despite the S&P 500 falling, the big money index, the BMI, is actually at a 5-week high.
Right. That's a key observation.
So you've got the main market index going down, but this indicator of, well, big money activity is pointing up. That seems contradictory.
It definitely looks like a conflict on the surface. And the likely reason for this divergence is pretty important. It suggests a major slowdown in forced selling.
Forced selling, like people having to sell, not just wanting to.
Exactly. Think margin calls, maybe big fund redemptions, situations where selling happens regardless of price, because it has to. The BMI climbing suggests that intense pressure, that kind of mandatory liquidation, seems to be easing off.
Oh, okay. And are we seeing signs of that in specific parts of the market, like those areas that were getting hit hard before?
We are. If you look at, say, the discretionary sector.
Consumer stuff, entertainment.
Yeah, and technology, too. These were areas where, not long ago, the data showed pretty significant money flowing out. They were looking pretty toxic for a bit there.
And now?
Well, over the past week or so, the data shows a real lack of those big outflows. The large-scale selling seems to have dried up considerably in those key sectors.
So the heavy selling has backed off even in those previously weak spots.
Precisely.
Yeah.
It suggests that while overall sentiment might still be cautious, that sort of panicky need to sell in those growth areas has really subsided.
Okay, so forced selling slows, tech and discretionary outflows ease up. Does that mean it's like clear skies ahead? Should we relax?
Not so fast. It's a positive sign, definitely, but it doesn't automatically mean the coast is clear.
Okay.
What this suggests is that the market is trying to find its footing, trying to establish a bottom, you could say. We've been in what the data might call phase 4, sellers are in control, pushing prices down.
Right.
For a real sustainable rally to start, we need to see buyers step in, and not just nibbling, but stepping in with enough conviction and volume to absorb whatever selling is left.
And we're not quite seeing that big wave of buying yet, that phase 1 you mentioned?
Not consistently across the board, no. The slowing of selling is good. It might mean the worst of liquidation has masked us.
Yeah.
But that strong, broad-based demand,
Yeah.
it's not quite there yet in the data.
Okay, so if I'm listening, the main takeaway from this current data picture is be patient.
Patience is key.
Yeah.
Watch for clearer signs of buyers getting active. The data suggests this shift, this turn, could actually happen when sentiment feels pretty low, when people least expect it.
It often happens, right?
It often does.
Yeah.
And it reinforces that classic advice, too. If you're a long-term investor using these bigger down days to potentially pick up shares in high-quality companies, that can be a sound strategy over time.
Right, buying quality on weakness. Okay, that covers the now. What about the history lesson? This death cross, it just sounds so final. Should people be, buying stocks into one?
It's the million-dollar question, isn't it? And looking back is really helpful here. We went back and looked at weekly S&P 500 data, all the way to 1978.
Wow, okay. Long view.
And what we found might surprise you. These weekly death crosses, they've happened 621 times since then.
621. Seriously, that's
Yeah.
way more frequent than I would have guessed. It doesn't sound like some super rare event then.
Not at all. And it makes sense when you think about it, right? If the market pulls back for a decent amount of time,
The moving averages are bound to cross eventually.
exactly, a sustained downtrend will naturally cause that shorter-term average to dip below the longer-term one. It's just a mathematical reflection of prices falling over time.
Okay, so it happens fairly often, but the real question is, what happens after it happens? Once the 50-day is below the 200-day, what does history show for the S&P 500?
Well, this is where it gets interesting for investors. Looking at the average performance after those 621 weekly death crosses,
Yeah?
3 months later, the S&P 500 was actually up, on average, by 2.2%.
Okay, positive. Modest, but positive.
Yep. 6 months later, the average gain improves to 4.1%.
Getting a bit better.
And then if you look at 12 months, 1 year after a death cross, the average return jumps to positive 10.4%.
Oh, okay. Over 10% a year later on average.
And it gets even better if you stretch it out. 24 months, so 2 years after a death cross. The S&P 500 was up an average of 25.2%.
25%. So, despite the terrifying name,
Right.
historically, the market has actually tended to climb higher in the months and especially the years following a death cross. That really flies in the face of the panic narrative.
It absolutely does. The historical data suggests that while, yes, you might get some near-term weakness or, let's say, wobble.
A bit of chop.
Exactly. Some volatility right after the cross happens isn't unusual. But it hasn't historically been a reliable signal to, run for the hills or expect a prolonged bear market.
Especially not for long-term investors.
For those with a longer time horizon, history suggests these have often been periods followed by recovery and decent growth.
Okay, so putting it all together, the current data suggests selling pressure is easing off, even if big buying hasn't kicked in yet.
Yeah.
And the historical data shows the death cross isn't necessarily the market killer its name implies. So what's the actionable takeaway for our listeners right now? What should they focus on?
Based on this whole picture, a sensible approach, particularly in uncertain times, is often to focus on what the data tends to highlight as institutional favorites.
Meaning?
High-quality companies, strong fundamentals, solid balance sheets, businesses that large institutions are clearly investing in. These tend to be more resilient when the broader market gets choppy. Identifying those can be key.
Focus on quality, basically. Got it. Okay, let's sum this up then. Key takeaways seem to be: 1, that scary-sounding death cross is getting headlines, but
the underlying data, like the BMI and the sector flows, suggest the really intense selling might be letting up.
And 2, looking back at history, this death cross pattern, well, it happens more often than you think, and it hasn't typically signaled disaster. Actually, market returns have often been positive afterwards, especially longer term.
That's a great summary. Near-term bumps are always possible, maybe even likely after a signal like this. But the overall data, both current and historical, doesn't necessarily scream panic for long-term investors.
Right. So maybe here's a final thought to leave everyone with. How often does market sentiment, driven by these widely reported, maybe scary-sounding signals like the death cross, actually create potential opportunities? Opportunities for those who are willing to look a bit deeper, check the actual data, understand the history, maybe find value when others are just reacting to the noise. What other indicators out there seem frightening on the surface but might tell a different story underneath? Something to think about. Thanks for taking this deep dive with us.